So this is the eighth reading that we have reached now, is the enterprise risk management and future trends. So like we had understood the enterprise risk management, that there are divisions and you need to take a holistic approach of all the divisions together from a top-down process. And now we understand the future, what it is, how it works, and the future trends. So the traditional system was called the silo-based risk management. Silo-based means that all divisions are managing their risks individually, and there is no cross-functional interaction correlation considered between them. So we developed a centralized framework called the ERM, and these are the differences between the two. So under silo-based, the risks managed were managed within the lines of business, and ERM, there is a review between the business lines, cross-functional areas, diversification, concentration is considered, everything is done. Then isolated risk managers, integrated risk managers, obviously, and a CRO. Here, in silo-based, multiple risk metrics that cannot be compared because every division is doing it individually, so it might not be comparable. However, here it's top-down, enterprise-wide together, so it's comparable, obviously. Then here, silo-based. So what might happen is that the risk can be netted off between divisions. There might be cases where the correlation is negative, or some other netting transaction might be possible. For example, this division has positive future cash flow with you, and this division has a negative future cash flow with you. So it's technically netted off. It should be netted off, but under silo-based risk management is not done. What if the under silo-based, this division hedges your risk and this division also hedges your risk? So that is an extra cost, which does not have to be paid under ERM. Then we move to risk management and risk transfer are not integrated in the balance sheet and financial strategies. Obviously, because since it is not top down, it's not organization wide. Risk management is not there in the balance sheets and financial statements. So ERM benefits and costs. ERM helps managers define the risk appetite, focus on threats, emerging risk, regulatory compliance, reassuring to stakeholders. It considers crossover and cross-functional risks, correlations, optimization of risk transfer expenses. Like I told you, Division 1 hedges one risk and Division 2 also hedges one risk that is not optimized. Then risk is incorporated into business model selection and strategic decisions of the bank, because it is done on a top-down basis. The top-level board of directors and chief C-suite managers are also considering risk management. ERM best practices. So corporate governance is critical in the implementation of a successful ERM, because if there is no strong corporate governance, the enterprise-wide risk management would fail if the top-level management is into committing fraud and other operational risk, operational loss-based activities. So this is again theoretical. ERM program dimensions. So set the correct risk targets, risk appetite, strategic goals. You develop a structure, you give roles to different people, you establish a hierarchy, and then there are different metrics. How do you calculate those metrics? For example, VR. So all divisions will calculate VR in this format, in this type. For enterprise-wide reporting, they might calculate it individually for their own purposes, but for the enterprise-wide system, they will have to make it. There will have to be unity. Then strategies are built, which are built on a top-down level, and then they trickle down into individual divisions as well. The last one is firm's risk culture. Now, culture is very important because the firm can develop strategy, monitor strategy, the firm can do everything. But what if the frontline managers don't have the culture of in them to uh, take lower risks, to not take unnecessary risks? What if the managers are not cultured enough? They don't understand the goals. Their goals are not aligned, and they focus on short-term profits. In that case, the entire structure fails. So, the culture, best practices, and behaviors need to be instilled in managers. So, next we see this risk culture itself, because it is very important. So the risk culture of a firm is the goals, customs, values, and beliefs that influence the behaviors of employees. So there were a number of scandals, like I told you, rogue trading, labor manipulation scandal, money laundering, accounting fraud, etc., that are possible if there is a weak risk culture. So there are key risk culture indicators, four of them, tone from the top of the organization. So if the top management is very strong, in control of the risk goals and appetite, and they communicate it well, then that might be a good indicator of the risk culture in the organization. The second is effective communication and challenge. Are opposing views valued? For example, if someone raises an opposing view, is it valued or is it struck down in the organization? Because if it is struck down, then that manager might be incentivized to go against the organization and the risk culture may be hampered. Third one is incentives. So are the compensation plan profit based or are they long term based, like we have discussed numerous times before? Is there accountability? Are expectations clear? Escalation processes used? For example, if I have an issue, I escalate it to my manager, they raise it to their supervisor, and so on and so forth. These are the four basic indicators. Now, there are other factors as well. Knowledge, knowledge of the firm's risk appetite. If I know, if the managers know, if it is well communicated to them, it is repetitive. First one is communication, risk literacy. So again, if the managers are educated enough in understanding what are the negative impacts of taking very high risk, this is risk literacy. Flow of risk information. Does information risk about risk flow across the firm? So it's top down as well, but it should be information should flow across the firm as well through different divisions, and there should be links and discussions because if the risk could be netted off directly between the two divisions, that would be great. Risk reward decisions of managers. Are managers consistent when it comes to risks and rewards in the context of the firm? Again, repetitive. It talks about the compensation. Are they not? They Risk culture is good if they are not taking excessive risk to earn some returns. Then risk management stature. Does the CRO and other managers have a stature in the firm? If the managers don't respect the CRO, then they obviously don't respect the risk management process. Whistleblowing and escalation. There should be a system in place to escalate the issues. Priorities of the board. So the board also needs to understand the risk because they are the ones who create that risk management process for the firm, and then they identify the risks. Last one is actions against offenders. So the actions must be taken against people who are continuously offending or going against the risk standards. Identification of risk culture concerns and incidents. Can the firm identify risk incidents and the actions that were taken in response to violations? Obviously, the firm needs to take actions against such violations. So that was about risk culture and factors that may prevent the firm for developing a robust risk culture is that risk indicators become risk levels. So in many cases, what happens is that if you're managing someone too much, like then you're not letting them rise up, you're not letting them take any risks, you're striking them down with everything, they might be inclined to not perform that well. Risk education. So there is not enough education in the managers about the impacts of taking excessively high risk. Risk across the organization and across time. Again, it's very repetitive, culture cycle. So in times of crisis, culture obviously goes for a walk in the park because people forget everything and they just need to recoup their losses. And the curse of data. So there is an ever increasing amount of data available for analyzing risk. For example, the number of sick days taken may be a risk or risk culture indicator. As data becomes more plentiful, firms may need to employ machine learning to draw useful insights and conclusions from abundance of data. Scenario analysis and stress testing. Again, we've done what they are. I will not explain. Basically, push variables to the extreme. In scenario analysis, you push all variables. In stress testing, you push variables one by one, and you understand the effect on the organization. So, how does the implementation affect the ERM program. So advantages include the risk frequency is irrelevant. The risk must simply be plausible. So for in scenario analysis, we don't see how many times this risk will impact the organization because you're pushing it to an extreme end. So even if it happened once, the organization is next to finish. So only the probability of happening even once needs to be considered. That is what it says over here. Second one is scenarios can be intuitive and transparent. Scenarios must be plausible again. For example, you can't say interest rates goes up to 100%. I mean, they might in the future, anything can happen, no one knows, but in general, even the extreme scenarios must be plausible. Firms must imagine the worst thing that could happen. It helps focus on key risk types and exposures. Firms see potential warning signals. For example, if you're approaching that scenario, you know you need to stop this business or you need to withdraw your money from an investment. And just read through the disadvantages are the probabilities are difficult to estimate, scenarios are complex. Now, who imagined COVID would cause such a big crisis? I mean, there were people who made movies, etc., but you get what I mean. Is the firm developing the right scenarios? Again, same thing repeated. For example, some things are given as advantages, some things are given as same things are given as disadvantages. So just read through this. Explain the use of scenario analysis and stress testing programs in capital planning. So there are a few crises mentioned: 1997 Asian crisis, 1998 debt, Russian debt moratorium, 2009/11 effect on markets, 2007 subprime mortgage crisis, 2008 failure of Lehman. So just read through all of them, like the impacts on the financial markets. Go to Wikipedia, read through. It's very interesting. So now what happens is that when one large organization fails, the effect trickles down into the whole economy as a whole, which is called systemic risk, not systematic risk, systemic failure. Because if one very large organization fails, it causes a strain on a lot of other GSIBs and SIFIs as well. So we need to consider that correlation as well, the increase in correlation during stressful times, etc., etc. And the Dodd-Frank Act and comprehensive capital analysis reviews, etc. These were regulations that came up for stress testing, and they developed three scenarios: baseline, adverse, very adverse. So you need to consider all of that. Then the CCR requires projections over a 9 quarter horizon. It's just theoretical. You read through and you keep these in mind. This 9 quarter horizon, it may be asked as a figure on your exam, and what the banks must forecast. So they might be given in the options. So A, B, C, D. One of them, three of them will be correct. One will be incorrect. So you need to point out which is incorrect, which is not something banks must forecast. And you can read through. There's something called COCO bonds also, which is contingent convertible. So if bank has issued a bond, it is paying interest. But in case the bank is in a bad situation, bad scenario, the bonds will become into equity. Obviously, the banks will have to pay higher interest on such bond because in times of crisis, people want their money to be safe in bonds. On the other hand, the money is becoming unsafe in times of crisis and becoming into equity, which fluctuates in prices. Again, theoretical. Just read through it. Nothing much for me to explain. If you have any issues, just ping me. And it's pretty simple. You can go through it. Thank you.